right, good afternoon, everyone, or good evening or good morning, I guess depends on where you are. If you don't mind, just type a Y in the text chat there, or I should say the question box more accurately, and go to. Just let us know. You can see, you should see some video, you should see a slide that's up there. You can hear our voices. Just make sure everything is working properly. All right, Deborah says yes. Yes, okay. All right, perfect. All right, so again, welcome to this exclusive FFR trading webinar featuring expert trader Joe Duffy. We're thrilled to have you here as we dive into how AI-driven trading and precision strategies can help you take advantage of options trading and take that that trading to the next level. Some of what we're going to cover today. All right, obviously we'll cover the risk disclosure, very important. We'll introduce you to who we are here at FFR Trading and what our role is. For those of you that don't know, obviously we'll introduce good friend Joe Duffy here. And Joe is going to talk about the strategies he's using for trading in the markets in 2025. We'll have a Q&A after that. Hopefully we got a special guest lined up, one of Joe's subscribers that will kind of share his experience with you. I hope we'll get that technical issue worked out and get him on at the end here, and then a summary of the course details, everything that comes with these programs. So again, the risk disclosure. Obviously, trading is risky business. There's no guarantees of success in trading. Understand that the strategies that we discussed today are powerful tools, but it's essential to approach trading with a disciplined, proper risk management and a solid strategy. So let's talk about who we are here at FFR Trading and what our role is. For those of you who may not be familiar with us, FFR Trading is dedicated to connecting traders with top performing strategies and expert guidance. Our mission is to help traders like you find proven, results-driven strategies that align with your financial goals, whether that's options trading or AI-driven systems, market analysis from the best in the business. We don't just offer strategies, we vet the traders, their track records, continuously monitor them to ensure effectiveness. And today, again, we're excited to share one of our most successful partnerships with none other than Joe Duffy. Let me introduce you to a little bit about the team here at FFR Trading. Michael McGinnis here, the president, and some of you are familiar with Michael as he's done some of these webinars himself. Alicia and Lauren, a lot of this wouldn't happen without their help for sure. You see this handsome guy right here, you might recognize him. And then the strategists and the directors, account managers. So when you call us here at FFR Trading, you're in good hands. These are market veterans, very well versed in the markets, and they can help you build a portfolio, a diversified portfolio of strategies, which you really need to navigate the markets here. All right, let's bring in Joe Duffy. I think you can see Joe here. Joe is a veteran trader, many years of experience, not just with options, but also trades proprietary accounts with the futures markets, been involved in Forex with one of the major big banks, developed a number of systems that are all generating over 100% annual returns on average. Has taught many global seminars, investing, coaching, some more of Joe's background. So Joe, where are you? I think you're at the Winter House today. Where is that exactly?
I'm from Canada, John, but right now for the winter, I'm in Palm Springs, California.
Not a bad place to be right now. I'm sure it's probably snowing back home in Toronto.
It's very snowy back home, yeah.
Right.
Yeah. And very sunny here. Yeah.
Yeah, so I'm here in Orlando, so we've got a nice sunny day here. So we both getting away from the snow here. Talk a little bit what you want folks to know about your background, Joe, because obviously it's very extensive. I know you did start off in the trading championships. That's kind of how you kicked off your career. Talk a
Yeah.
little bit about your background.
Okay. Yeah. That's probably the major thing that really got started. And I was fortunate, I guess, at the time. A guy named Norm Zeta created this thing called the U.S. Trading and Investing Championships, and it was a big deal. Like it was on the front cover of Barron's, and Futures Magazine, Stocks and Commodities Magazine. They all covered it, but Barron's did several articles on it. A lot of people like Paul Tudor Jones, who was maybe the best hedge fund manager ever, got their start there, but many other hedge fund managers as well. Uh, so I was just fortunate to be in the right place at the right time. So I was in that for 3 years, and it's an audited real money contest. So I had, triple digit returns each of the 3 years. So I was able to leverage that into a position for one of the major banks where I traded the proprietary bank's book, which means I traded the bank's money for their account and risk as a profit center. And after I also when I was with the bank, uh, I went in early, wrote what I thought, what our markets were looking at for that day. And there's something called the Greenwich Survey, which is a company in Greenwich, Connecticut, which surveys all the major banks and institutional clients and asks them, what are you doing well? What are you not doing well? Uh, Mine was the market letter was the number one uh, analysis among that group. So uh, that was good. And after that, I just kind of, I guess, I don't want to say semi-retired. I guess I did. Did golf and do whatever else I like to do. Didn't miss kid sports, and but I was also doing some work. I was working with Futures Magazine. We had a market letter, um, and I was doing trading, obviously, and still doing it today. Doing prop trading for, if anyone's familiar with the whole prop trading industry, which is really exponentially growing in the futures market. So if you're not familiar with it, I would just look up prop trading and you'll find a whole bunch of information. So I'm funded to do that, and yeah, and I'm working with FFR and the options, and still doing everything that I enjoy, including this. So that's my story of getting here.
All right, fantastic. And you do have two flagship programs that we're going to take a look at here. The first is the Target Zone Options Program. You also have your Quantum AI we'll look at in a moment. These programs have helped traders really maximize their returns while at the same time minimizing risk. And we'll talk about the risk management side of things as well. So let's start by breaking down each of these powerful systems here. So Target Zone, we're looking at results based on our account size, allocating approximately $1,000 to $1,200 per trade. These numbers are now non-compounded that you see here. But let's talk about the academic details. This program is a bit unique because I believe it's the only program that we offer where it's a spread trading program primarily. Not that you don't just trade, you can't trade just straight up puts and calls, but you are primarily utilizing debit spreads. So talk about, and I know you're going to go into more detail on how you how this strategy works with Target Zone, but talk about the strategy that you utilize with Target Zone here.
Yeah, it's sort of like this. I think like I don't always put a spread on initially, but a lot of times I will put the initial put or call will turn into a spread. And I'll go into the reasons for that, but there are very good reasons for it. And basically, I think one way to look at it, and this isn't my analogy, but I heard someone else say it, so I'm going to borrow it. Being able to use the spreads is, it's like if you had a car that can only turn left, you could get to where you were going, but it would be hard. Uh, but the spreads offer you a lot more flexibility because we can turn every which way. And and so that's why I use them. And well, I'm going to go into more detail in a few minutes about how I use them. But yeah, the ability to be hedged to some extent, it's a really useful tool.
And you're trading options on some of the most liquid stocks and ETFs. We'll look at your proprietary Scoupe indicator because this is something, or just talk a little bit about how you utilize your proprietary indicator with your trading here with Target Zone.
Okay, we should do that as we go through the charts then. Did you want to talk about the AI a little bit first or not? Or do you want to go right to the Scoupe?
Well, let's go. Let's just continue with Target Zone here. So
Okay.
the average number of trades per month, about 4 to 6 trades per month. Obviously, that can vary with market conditions. Talk about the risk management side, and then you've got some ways of picking targets and so on with your strategy. Talk about those two ends of the program.
Well, the spreads are sort of a built-in risk manager, because if you buy something for $5, and then a few days later you sell something against it for $1.50, say, or pick any number, you've already mitigated your loss, because that $1.50 in options trading is yours no matter what happens. You're always going to keep that $1.50. So now your exposure is only $3.50. So I've had many times where I've written enough things against an option that I own that it's cost me less than zero by the time all the things have expired that I've written against it. So, and I'll explain. That may seem like mumble jumble if you don't know how it works, but I'll get to that in a minute. So yeah, spreading is one way to manage the risk for sure. But sometimes you just have to say, okay, that's wrong. I had an IWM position. We've had a really good run of winners here, but I did have an IWM position a couple of weeks ago, I think, that I just had to cut out. So you try to cut it out. If it gets to 50%, you try to cut it out there.
All right, excellent. And so let's look at the stats on the program. So it's averaged 17% a month, with an annual average of 199, almost 200% for the year. You're winning 75% of the trades. But here's the beauty: the average winner is $501, the average loser just $359. So not only do you have the high win percentage, winning the vast majority of the trades, but when you do win, the wins on average are bigger than the losses. So you kind of get the best of both worlds.
Yeah, that's obviously the goal for sure. Yeah.
All right, so let's take a look at the Quantum AI program. Now, there's a new program that you started. Talk a little bit about how you came up with this program. Obviously, you're on kind of the cutting edge of AI, and this kind of a program that, as I think you said, it kind of picks the trades for you, but you put all the effort into kind of programming it, if you will.
Yeah.
Right?
Yeah.
Talk about that.
Well, AI is a bit, no matter what field it is, it may be just a bit of a misnomer. It doesn't really think for itself. It just takes a long history of occurrences and extrapolates to what the probable outcome is going to be, and that's what AI is. And we've been doing that before we called it AI. But so for this particular program, if we took, I can't remember how many exactly was there. I think it was 100 or maybe it's 200 stocks in our test, and we went back 40 years, and we used the same parameters on each stock. So there wasn't different rules for Apple than IBM than there was for NVIDIA. They all use the same rules. So basically, we would ask the computer, okay, if A happens and B happens while the C happened 3 days ago, what is the outcome, 5 days from now, 10 days from now, 15 days from now, sort of thing like that. And so you find patterns in the data. So when you've got hundreds of stocks over 40 years, you've got millions of data points. So when you have millions of data points, your chances of success going forward are a lot higher, obviously, than if you had 100 data points, because you've got so many data points to look at. And the other important point is, like I said, you're using the same rules for each stock. And even though stocks can move dramatically different from each other, when these certain patterns occur, they produced similar results in terms of the success. So that's essentially what AI is. And for me, the difference is, if I can go into the difference between Target Zone has some Joe fingerprints on it. When to spread it, even when to get into it. And we'll talk about Scoupe in a minute, which is empirical, but also there's a little bit of room for Joe in there too. So it has my fingerprints on it, the Target Zone, and sometimes for better or for worse. And the AI doesn't. It just spits out the trades and they're executed, and that's it. So it's completely 100% mechanical, and I don't even have to be here. Someone will input the trade for me.
All right, fantastic. Thanks for the clarification between the programs. And this one also, this does not trade spreads. This is just straight buying a put or buying a call. So it does go both directions, but just through the use of a long call or a long put, correct?
Yes, that's correct. Yes, the AI, because again, since it doesn't have my fingerprints on it, it would be beyond the capabilities of AI to say, okay, I'm going to spread here, I'm not going to spread here. So yeah.
All right, and average about 4 trades per month. And these are what we consider short-term moves, maybe a few days to a month that you might have a position open, or the AI may have the position open.
That's correct. Yeah.
So let's take a look at the profit summary here, because these numbers are phenomenal, averaging 51% per month. It's average annual return of 606%, winning 77% of the trades. But here, look, your average winner is $602. The average loss just $265. That's a pretty healthy win-loss, average win to average loss there. Tell us a little bit more, kind of inside these numbers. What are you seeing, over the period of time that you've been running this program?
Yeah, once in a while it has little periods where I think it had a streak of 3 or 4 or 5 maybe in a row where it didn't win. But I mean, in the last year. But normally it's pretty consistent. But like anything, and you have to be prepared for this. It's never a straight line. Obviously, you're gonna have losses sometimes, and sometimes you're gonna have streaks of losses. It's just like, I hate to compare it to roulette, but anything like that, but it's just something everyone can relate to. Assuming there's no 000, just red and black, there's a 50% chance that it's going to land on one or the other. But that doesn't mean every other spin is red. You can have 10 spins in a row that are all red, right? But over the long run, it's going to go 50-50. And so similar to this, but over the long run, historically it's made money. So that doesn't mean it's going to make money every single time, or it's not going to have a month or two where it loses money. It just, you're in it for the long haul.
And for those that have questions about the numbers here, I'll put up the numbers for you to call. You can call in, and they'll go through. You'll have a strategist will go through the numbers piece by piece with you, and give you all the data going back as far as the programs go. All right, so just give us a call. I'll put up the numbers in just a bit. We will have a Q&A with Joe in just a bit when Joe goes through his part of the presentation. So at this point, I think that's what we'll do, is we'll get ready to switch over to you, Joe. I'm going to turn that presentation over to Joe. He's going to do a deeper dive into these strategies, show you exactly how these systems work.
Okay.
Right, let me get you set up, Joe.
Are we going to go through the Scoupe, John, or are we just going to go through
my bad.
trading?
Yeah, let's do that first.
Okay.
My bad. So let me pull up Joe's proprietary Scoupe Indicator so you guys can see, what he's working with his programs, especially with Target Zone. So talk about what we're seeing here, Joe, the components of this indicator and how this was developed.
Okay. Well, this is, first of all, you need to determine which way the trend is. This whole idea of Scoupe is that you buy dips in a trend, buy dips in an uptrend, sell rallies in a downtrend, don't do anything in a flat trend. Okay, so I'm looking for some empirical way to tell me when to do those things. So what I've got up here is you can see on the price chart, there's a whole bunch of red and blue lines, and some of the bars are colored red as well. So basically, when everything's red and all the lines are above the price, you want to be short. And when everything's blue and all the lines are below the price, you'll want to trade long. So that determines my trend. Okay, so I want to know whether I'm buying dips or selling rallies. So that mumble jumble there tells me basically, red I want to be selling, blue I want to be buying. And if you can see, if you just did that, you'd be okay on its own. But we add more to it to really get the most out of the trend by buying the dips in the trend. So the next chart will show you how we go about doing that.
So let's look at the next piece here.
Okay, so you can see the oscillator below the price top there. I've gotten rid of all the lines on the chart here, okay? But you can see the blue and red. The blue is the histogram, which is the vertical lines that John's pointing out there, okay? And the oscillator is the little red line below it, all right? So basically, if the histogram, the blue one, is above zero, and the oscillator, that cycle turns down and starts to turn up while the histogram, the blue one, is still blue above zero, then you buy. So you can see, if you start at the left end of the chart there, you can see where I've put the little arrows under the price, and they will match up to an area of on the price chart there where um, where the buy signals were. And in each of those cases, you'll see, um, histograms above zero, oscillator, cycle oscillators below zero, it turns up, cycles turning up. Not perfect, but damn near. And you can see similarly, if you look on the last third of the chart there, there's a couple of sell signals where it's the exact opposite, where the histogram is below zero, the blue is below zero, and the cycle oscillator starts to turn down from above zero. Okay, so those are your sell signals. Now, if you get into a real chop, like we saw, John, if you can sort of highlight, I guess at the beginning of almost right in the middle of the chart, at the beginning of the year there, you can see a period where there were no signals at all, and that's because there was nothing to do for that whole period because we were in chop. So we didn't get the trend, so we didn't get a chance to pull back in the trend. So that's how I use the Scoupe oscillator in conjunction with the trend to find my entries. And the last chart, if you show up there, John, will kind of puts it all together now, so you can see where the buy signals were within the trend. So I'm buying the blue, basically buying blue, but I'm not only buying blue, I'm buying blue on those little dips. So that's where the arrows are that we derived from the Scoupe indicator in the last chart. And similarly, on the last third of the chart, you can see some sell signals that similarly were derived from the Scoupe indicator, and we're taking those sell signals when there's a red trend. Okay, so basically that's one of my major tools. I also use something that I call X-ray, which is a little bit more trend following. This is a little bit more find the trend by the dip. The X-ray is a little bit more aggressive, just tries to find the trend more than by the dip. So, but both of them I use a lot to make my decisions, and that's basically how most of the trades are done in target zone trading. And I'll explain a little bit more about the methodology when John turns it over to myself here.
And so now is probably a good point. I'll do that. And we'll take a deeper dive into these strategies that we're talking about, both target zone and the quantum AI here. So Joe, let me get you set up here. And you should get that little pop-up. So you can take control.
Okay. All right. Everybody see the screen okay?
Looks good here.
Okay, good. Okay.
Yep.
Okay. So we talked about spreads a little bit before, and I didn't want to go into too much detail because I didn't want to step on my own toes here. So, a spread for me is basically this. There are many different kinds of spreads, but normally the spreads I do, I'm long a far dated option. So, for instance, if today is oh, John, I've got myself in my picture here. How do I get rid of that? Okay. Okay, there. If I'm long let's say a June option, I may be short an option that expires at the end of February. Okay, so uh, it is very similar if you're familiar at all with the whole concept of covered rights, where you buy a stock and then you sell an option against it. This is essentially the same similar strategy, except instead of owning the stock, we own a far dated option. So the far dated option is essentially the same as owning the stock. So it is essentially a covered right strategy, except with a bit more flexibility, to be honest. So I will show you a little bit about why I like to do this right here. Okay, so this is a time decay in options. So options that have 90 days left, you can see by the time they have 80 days left, how much time is eroded on that option? Not very much. So if you paid $6 for this option right here, 10 days later, it may be worth $5.60. Okay. Now, 60 days, it may be worth, $5. And then in 30 days, it may be worth, $3. So you're, even though the time isn't gaining any faster, the decay is gaining faster. And the faster it gets to expiry, the closer it gets to expiry, the more time decay you get. So this is why I like to be long an option out here that, say, in 10 days declines from $6 to $5.60, assuming the stock doesn't move anywhere. Where here, the final 10 days, that the option that you're short declines from $2 to zero, assuming all things being equal. Okay, so this one may decline 40 cents. This one declines $2. Okay, so and essentially this is the floor trader model. The floor traders are always required to make a market. That's their job. So if somebody wants to come in and buy 1,000 options on IBM, the floor trader is required to sell the institution those 1,000 options. Okay? So he'll sell the options, he'll price them, sell them to the institution, then he'll go into the actual stock market and do a ratio of how much stock he needs to be long or short to hedge his option. But he's always selling the option. Okay, so this curve is always working for him. Okay, that's the beauty of being the house in options, or being the floor broker in options. That curve is always working in your favor. If you're a retail trader and all you're doing is buying and selling options, you are always fighting that curve. So not only do you have to be right, you have to be right faster than the option decays. So that's one of the advantages of spreads. And I talked about the covered right concept. So I'm have my position far out, 3-4 months out, and I like to sell options that are, a week or two out against them. Okay, because I want to take this right hand part of the graph here where it says fast time decay. I want that working for me. Okay, so that's a big advantage, and over the process of just buying puts and calls, you don't get this advantage. You pay it away sometimes, depending on how much long you hold your options, but you don't ever get the advantage of uh, having it work for you. And that's one of the great things about the spreads and the way I use them is I get that fast time decay working for me. I get the floor broker advantage, and you can save yourself a lot of misery. Um, you can turn it's mediocre time in mediocre trades into halfway decent ones just by using this time decay to your favor. So let me give you an example of a stock that we're in now. So I bought a Boeing calls 180 expiry at 5:30. stock moves up a little bit. I sell the 185 call that expired in a week for $1.40. Okay, so my net cost now is $3.90. Paid $5.30, got $1.40. So I'm only in for $3.90. So now the most I can lose is $3.90. Okay, before I could lose $5.30 because that's what I paid. Now I'm down to $3.90. So that call's already expired. This is a real trade that we did. Okay, so it's zero. So now my cost is $3.90. I still have the 180 call. So today what I did is I actually sold some options against that again for $2.50 and change. So my $3.90 cost is now down to $1.40 because I sold for $2.50. So $3.90 minus $2.50. My net cost is now $1.40. Remember, I started off $5.30. I've got my net cost now down to $1.40. So in the absolute worst case scenario, the most I could ever lose on this trade is $1.40. Okay. So we'll see when this call expires in 2 days what I have to do. I may roll it over to the next week, but whatever. I got about a $2.50 time value for 2.5 days. Okay, so by that I mean the stock was around 180 and 180.30. Okay, $180.30. So intrinsically, that 180 call is worth 30 cents. It expires in 2 days. So if the stock stays right there for 2 days, the call is going to be worth 30 cents. But I got to sell it for $2.50. Right? So the difference between what it's intrinsically worth, 30 cents, and what I sold it for, $2.50, that $2.20 difference is the time value. And if we go back to my chart here, that $2.20 is going to erode right here on this part of the chart. It expires in 2 days, this Friday. So no matter what happens, that $2.20 of time premium is going to be gone. Okay, and I'm going to benefit from it. Okay, it doesn't matter whether the stock goes up or down. Okay, I'm still going to get that time premium in my favor. Okay, so depending on where we are this Friday, I'll be left with an option here that I paid paid $5.30 for. That's now costing me $1.30 or something like that, or close in that range. Okay, so even though this stock has moved up a little since I got it, maybe a couple of dollars, I've rapidly depleted my cost of the option, much more so than if I just have held the call. In fact, if I had held the call, I'd probably be a little bit underwater right now, even though the stock's moved up $2. And why would I be underwater right now? Well, because the time decay of that option, right? So instead of me being underwater, I've now got a net cost of this of $1.30, and anything's possible, but it would take a crazy, gap move in one way or the other for me to actually lose any money on this spread. And the most you could lose in the absolute worst case scenario will be $1.30 because that's all I've got left in it. Okay, so I'd say that almost for certain this spread is going to make me some money, to be determined how much, but almost for certain. Where if I had just bought the call today, I'd have to decide, well, do I want to get out even, or do I want to hang on? Whereas the scenario I'm in, I'm almost for certain, or a very high probability, I'm going to make some money on this depending how things unfold. So I hope that's clear, because this chart here is the key to how I'm trading options, okay? And this is why I like to be long, and I'm going to repeat myself because some people aren't as familiar with options as others. So I want to make sure that we get this at least conceptually clear, so you have a rough idea of what I'm talking about here. I want to get this decay working for me. I don't want to pay it away like the average retail trader is. Okay, I want to work it for me. So I use that covered right strategy where I'm long something in the distance and I'm short something against it that's going to decay a lot faster than the thing I'm long. Okay, so let me give you a hypothetical example again of a stock. Let's say Boeing. Let's say the stock stays dead still for the next 2 days. So I got in when the stock was $180.30. I got 250 for the option. If it's $180.30 at expiry, again, what's it worth? It's worth 30 cents, right? Yeah, because it's 180 strike. The stock's $180.30. This option's worth 30 cents. But I sold it at 250. So I just pocketed that $2.20 of time value. Now, what would happen? You ask, okay, well, what happens if the stock goes to $3 or to 183? So the stock rallies $2.70 from where it is. I sold this for $2.50. I'm going to have to buy it back for $3. So I'm losing 50 cents. Well, why did I do that? Well, if the stock rallies $2.70 to 183, my long dated option is going to rally a couple dollars as well. So it's up $2. I lose 50 cents on this one here. So I'm still up. Okay. But what happens if the market goes down to 179? Well, now I pocket the whole 250. And while I may lose $1.50 on my long dated option, I've made 250 on my short dated option. So you can see no matter what the scenario is, up market, sideways market, down market, I am going to pocket this fast time decay here, and it's going to help me appreciably mitigate any loss I had by being in a sideways market or an adverse market. So that's one of the major strategies that I like to use. So yes, I like to take a directional trade at first, but as soon as it starts going my way, then I like to set the spread up. And by what I would say call legging into the spread like that, doing the first leg first and then the second leg later, you get an even more advantageous spread, right? Because when I first bought this call at 530, this option here might have been 80 or 90 cents. So I waited till it went up to $1.40, then I did it. So that's how I like to get into the spread. Okay, so I like to get in with my initial cost of 530 first, so I know where my cost is. Then I like to start selling stuff against it. So this Boeing spread right now, as I said, I think my cost here is $1.40 or something like that. So it's going to be pretty hard, not impossible. Nothing's impossible. It'll be pretty hard not to make money on this option, even though the stock's, it's up a little bit from where I got in, but not a whole lot. Okay, now the other interesting strategy, and you can use this with the strategy I just used, and in fact, if it happens, it's really awesome. But once in a while, you get option mispricing, and I know you're going to think, well, how do options get mispriced because they're, professional traders, blah blah blah. Well, it really isn't professional traders that misprice options. What happens when market gets volatile and is retail traders rush in and they want to make a millionaire by next Friday, right? So what happens? The price of the option gets inflated. The time premium inflates because the market's so volatile and it's moving so quickly that people are willing to pay that premium because they think it's going to keep going in that direction. So just get me in. So when we see that spike in volatility, where do the retail traders rush in? Do you think they rush into options that are 4 or 5 months out? No, they rush into options that are expiring in a week or 2 weeks or a few days even. Okay? So that's where your mispricing occurs. So you'll get inflation in the short dated options, but you won't get nearly as much inflation in the long dated options. And in those cases, just buying the long dated, which is pretty fairly priced still, and selling the short dated, which is overpriced, you can just use the floor trader advantage of that curve to your benefit. And it's really even not a directional trade. It's just a trade based on the relative value of long dated options compared to the relative value of short dated options gets out of whack. And it's because short-sighted retail traders are rushing in to try to take advantage of volatility. And so they're expanding the time premium on that short dated option. And when the time premium expands on short dated options, it is a gift horse to sell. Okay, and in these cases, like I've said here, a decrease in volatility or market trading sideways, even for a short time, As that volatility gets sucked out of the market, that's all that's necessary to create a profit. So the last trade we did like this, I'll give you an actual example. HXB, XHB is the home builders ETF. So it's an ETF of home builder stocks, Toll Brothers, and stocks similar like that. The stock's falling out of bed last fall. This down really hard, like 20% in a week or something. So what happens? The short-term options get vastly overpriced. And I'm not exactly, I can't remember 100% what options I use. I just wrote this for an example. So don't go, if you go back and look, it may not be exactly the right prices or dates, but for an example, it serves our purpose. And the numbers are pretty right on. Okay, I don't remember exactly the strikes or anything like that, but the numbers are pretty right on in terms of the prices. So what I did is I bought the December put for $5.20, and I sold the October put for $3. Now, as I recall, the stock was around 113 at the time, so these were slightly out of the money. Okay, but I'm going, why is anybody paying $3 for an out of the money option? Okay, when you know, like 2 months further out is only 520. If this thing, remember, there's going to be between October and December, there's going to be 8 expiries. Okay, so I've bought this, I can sell this against it, and I can sell something against it 7 more times before I get to December. Okay, so if I'm selling this for 3 and buying this for 520, and I get another 7 chances to sell against, what are the chances that I can recover my $2.20, which is my initial cost, right? So I buy 520, I sell $3, cost me 220, okay? But I got 7 chances, if I need them, to sell again against this option to recover that 220. Remember, the first time I got $3, okay? So it's not even a directional trade, it's a mispricing trade, okay? So what happens here is the stock bounces a little bit, and the October 110s, not the December, my mistype there. The October 110s expire at 0, so they've gone to 0. I'm now holding the December 110s at a net cost of 220. Okay. I then see I mispriced here. I just should say October, this should say December. That's my bad. I apologize. But then what I just did is I just exited the December at a loss of $1. Okay, so I pocketed the $3 because somebody was dumb enough to pay $3 for an out of the money option because the market was going to go to 0, apparently. So I sold them that option. Thank you very much. And I hedged it by owning this long dated option. So yeah, I did lose $1 on this long dated option, which is actually a big lesson because I wasn't even right on the direction. Okay? I lost $1 on the put. Okay, but I made $3 by being short to the greedy market chasers who were willing to pay $3 for that option. So I lost $1, but I made 3. So I made $2.20. Okay, and that was not even on a directional trade. That's just on a trade where you're looking, going, okay, the long dated option is still fairly valued, but the short dated option is overpriced. Let's take advantage of that. And if we go back here to the other example with Boeing, sometimes it happens where it's really awesome because you buy this one at 530 and then the market spikes up. So what happens? People can't wait to buy that 185 call because the market's going and it's going to continue going forever. Let's just jump in and pay whatever, right? So then you can sell this option here against it for a really, really high price. So option mispricing combined with this kind of spread is awesome, and when it happens. Okay, so basically those are the strategies that I use with target zone. Now, once in a while, guys, if this Boeing option here, I had bought it at 530, and immediately the stock goes $7 or $8 in my favor, which with Boeing could easily happen. I'd probably just sell this option. Okay, I wouldn't fool around with the spreading it because it just too many things could go not as well as if I just took the profit. Okay, so if I get a windfall profit like that, I'll just sell the option. Or sometimes, like I had a trade in MGM not long ago where I bought the option at 5 and sold it at $7 and change, just because you know what, the option premiums on MGM aren't that high, so you weren't really making much of a time value, so there wasn't much to decay. So, but the good part about that is when you buy the option, it trades almost dollar for dollar with the stock because there's not much time premium on it. So once in a while we do straight puts and calls for sure, but we want the flexibility to do this. Like I said, this is like uh, it just gives you so much more flexibility on trades than it does just buying straight puts and calls. Okay, so I think that pretty much covers what I want to talk about here today. Yeah. So those are the things that I look at for target zone.
Awesome.
So
Thank you, Joe. Yeah, that was fantastic. Um,
yeah, just let
guys,
me add here, John. Sorry,
yeah,
just
go
let
ahead.
me add. I know because sometimes hearing me talk is not. I maybe don't make it as clear as it is in my head. So if I haven't made anything clear here, and it's please ask me to go back and ask me to repeat it. I mean, I'm not trying to give you guys the exact science of this as much as conceptually. I hope everyone understands what we're trying to do. If conceptually you get it, that's great. If not, please ask, because it would be my fault for not explaining it properly.
Right, and kind of leading into us for the Q&A session here. So guys, if you have questions for Joe, you can go ahead and post your questions in the that question box there, and we'll get to as many as we have time for. But again, I'll provide the number for FFR if you want to follow up after, if you have additional questions, and we can have a strategist answer all your questions, go over all the performance numbers since inception, everything that you need to know, to make an informed decision on the program, and we'll cover more of that. And again, those of you that stay to the end, remember you will be eligible to receive an educational trading package from Joe and FFR Trading. All right, so stay till the end. So go ahead and post your questions if you've got them. Let's see what we've got. Joe, how do you pick your long-dated option? How do you choose your long-dated option and your short-dated option? I guess they're referring to the
Right. Yeah.
timing,
Right. Well, I guess you know what. There's really this is where I guess it's a little bit subjective. I just look at it and I figure, okay, where am I looking for this market to go? And then I choose based on where do I think I'm going to get the most bang for the buck if the market goes there, and where am I going to uh, how am I going to make out if it doesn't go there? So a lot of times all you can do is look at the ladder. And by the ladder, I mean for Boeing, say, you'll have 200 options, 200 strike options, 195 strike, 190 strike, 180, 175, 170, blah, blah, blah. So you can see sort of, okay, if the stock moves $5, the 180 option is now going to be the 185. So what's it going to be worth? So forth like that. So you can look and see, okay, if it goes against me for $5, what is my option going to be worth? So, that's how I decide how much pain I want to take or how much gain I think I can get. And for the short dated, it's usually I'm already long the long dated. So the short dated depends on the option that I'm long. I want to make it worth my while to sell it. So I don't want to sell too many things for 25 cents or 30 cents because it's not really worth it, right? So I'd like to sell something for more than $1 so that at least makes a dent in my original purchase. So it is a kind of a bit subjective, I guess. It's not a mathematical formula. Just by looking at the ladder and saying, okay, um, what's my risk and reward here at various strikes?
And Carmen wants to know, how can you sell one item 5 or 7 times and keep their money? Well, that's the magic of
That's
the
that's a good
strategy,
question.
right? Yeah.
That's a very good question. Now we're getting to it. Okay. Let me go back here to my slide. Okay. You know, uh, Okay, Carmen. Really good question. If I'm long again in this, let's say I'm long in June options of 2025. So that's kind of like my owning my stock in the covered right. I'm long the June options. So I sell option in February that expires next Friday. Now, let's say I sell XYZ stock at 100 strike price and I get $1.50 for it. If XYZ stock is under $100 by next Friday, then what is that option worth? It's worth zero, right? And it's expired. Okay. So it's done. It's off the board. It doesn't trade anymore. It expired at zero. So I still have my long June, but that February I just sold as expired and I keep the $1.50. Okay. Now let's say that XYZ stock goes up to 103. Okay. So now that option that I sold at $1.50, it's now worth $3 on expiry, right? Because it's 100 strike, stock's at 103, the option's worth $3. So now I lose $1.50, right? So what am I going to do? Well, first of all, I'll remember that if I lost $1.50 on the first one, I've probably made $1.50 or $2 on the long one. So I haven't really lost. I've just sort of hedged myself. But what I could do is say, okay, the options that expire next Friday are $4.20, say. Okay? So I'm going to buy back that $3 one and sell the $4.20 one. Okay. So now I've made another $1.20. Okay. Now, if the market next week turns around and goes back to 100, and that $4.20 option is now worth zero. So I've made $1.20, right? No, I've made I sold for $1.20 and I sold for $4.20. So I've gotten $5.45 of income. I had to buy that option back at $3, so I've gotten $2.40 of income. If it goes back to 100, I pocket the whole $2.40. If it stays at 103 or goes to 104, I can do it again. I'll buy back that option for $4 and sell the next one for $5. Right? And I can keep doing it, and I can keep collecting whatever time value is left in that option. Okay? So when you have to buy an option back and it's and then sell the next one, that's called rolling it. So yes, initially I sold for $1.50, have to buy back for $3, but I'm going to sell the next one for $4.20. So I'm adding another $1.20 to the kitty that I'm collecting. So and if it goes down back below my strike, I pocket the whole thing. Right. So and remember, if the market's going my way, I'm still making money on that long dated option, and it's not losing time value as fast as the time value I'm collecting by selling the short dated option. So part of the answer is that options expire for stocks every single week and for indexes every single day. So you just keep trading, you just keep selling on this fast decay part of the curve. Okay. And when it comes to expiry, you go out to the next day, and if you're trading the SPY or whatever, or if you're trading stocks, you go out to the next week. So you continually collect this premium here. Okay? So that's how you do it. They don't always have to expire at zero. You can just buy the one back that you sold and sell the next one. And a lot of times it'll happen where, let's say we sold that option at $1.50 and the stock closes at 101. Okay, so we made 50 cents because we have to buy it back at $1, but we sold it for $1.50. Okay, so we make 50 cents on that, but since the stock rose, the long dated option also rose. So a lot of times I'll find myself making money on both sides of the trade. Okay, so and why? Well, because of this fast time decay. Right, so I make 50 cents in the short one, but the stock goes up $1, so I may make 50 cents in the long one as well. Okay, so much better to do it that way than it is just to own the long one, because I'd only make 50 cents. Now I make $1, 50 cents on each side. Okay. And if that didn't answer your question, ask it again or ask me another question, because It was a really good question, and conceptually, that's what we're doing. You really got to the heart of it.
Yeah, great question, great answer. So, Denali comments, I'm new to all this, but I'm so glad that I joined. I've not heard anyone speak on option spreads. Your strategy is blowing my mind. How can I learn this? Denali, stay tuned, and I'll show you how you can get involved here. All right, let me just see if there's any other questions we can pick up. Let's see. I think I've got all of them here. So we'll move on, but if you have any additional questions, again, I'll put up the number for FFR in just a bit, and you can call in and have your questions answered if you didn't get it answered here. So I'm gonna take back control here, Joe, and I will, or we'll kind of continue on together here. Let's see. And hopefully we can get Herb's mic working here. All right, so let's go into the portfolio, the two strategies, and everything that comes with these strategies, because it's not just the signal service, right? It's all the educational material that comes with these programs. Okay, so the first thing, you're going to get direct access to Joe and his team, right? Email, phone, and Skype for any trading questions regarding the markets and the methodology. Right, that's number one. You also get direct trade alerts to your email and or cell phone for both Target Zone and Quantum AI. So you get the alert and then you can take action on that alert. It comes with everything you need to execute that trade properly, right? Not only the entries, but when to exit as well. You'll get the daily recaps for the trade updates, right? What trades have been opened, what's been closed, what you're still holding. You'll also have access to all the educational material on the methodology, describing the entry rules, the exit rules, the money management rules. And very importantly, Joe does a daily video, right? That keeps you up to date, what's going on in the market, how those positions are working, any trade setups that he's anticipating, so you can get ready for those, right? Another great learning tool there. We do also offer third-party registered brokers, right, that Joe's been working with many years that can execute these trades on your behalf. It would be your account, but it's for those who don't have time to execute the trades for themselves. Maybe you've running a business or you're working or whatever, right? So you can have a third-party registered broker execute those trades in your account on your behalf. So it's basically hands-free. You also get access to us here at FFR Trading and our team, who I showed you earlier. Our goal is to help you build a well-rounded portfolio of non-correlated strategies and traders, right? Because obviously there are periods when a strategy may work great and then it may go into drawdown. If that's the only strategy you have, you kind of suffer through that drawdown, and all strategies go through drawdowns, right? A good strategy will recover from the drawdown and go on to new equity highs. But in the meantime, if you have other non-correlated strategies, maybe doing very well, performing very well during that period where the other strategy may be down. All right, so we're going to help you build a well-diversified, non-correlated portfolio of strategies, right? Is the goal here at FFR. All right, what Joe's looking for. All right, we're not just looking for anybody here. We want you to provide your story, and hopefully we'll be able to share a story here in just a moment with one of Joe's subscribers, Herbert. Provide your story. How did you find Joe and FFR? What were you doing before and how is it going now? We also want you to provide your monthly brokerage account statements, right? So we can track your how well you're doing. If there are any changes that need to be made, right? We want to keep constant track of your performance, how the strategies are performing in those different markets and so on. Commit to a quarterly meeting, again, so we can go over your portfolio, any adjustments that need to be made, right? That the strategist can go through all that with you. And then if you're satisfied, right, provide a testimonial to us. And then obviously any referrals. So we do a lot of business just through referrals, as you have success, you're going to tell other people, right? That's the goal anyway. So here's an example. This is Herbert Solinsky, and a testimonial that he recently provided. We do have Herbert on today. He's just been having a little problem with his microphone. So I'm going to try to bring you in, Herbert, if you just to see if we can get the microphone working here. I can show you, because I believe we'll have him on video, but just want to see if we can. If not, I'll go through his testimonial here. But Herbert, if you can jump in, unmute yourself, and let's just see if we can get that audio working. It'd be great to hear from you, and it would be great for those here on the webinar to be able to hear from you know, a subscriber of Joe's that is doing quite well. So if you want to test your microphone and see if that's working. All right, I can't hear you. I'm going to go ahead and read your testimonial here. In the meantime, if you can get it working, great. If not, at least you did provide us with this. It said, the purpose of this testimonial is to explain my experience with option trading that causes me to recommend the two Joe Duffy services of quantum alerts and target zone with FFR trading. Before I began making option trades, I paid 9 vendors who sent me emails containing alerts for me to decide on making option trades. One of the 9 vendors was Joe Duffy with his 2 services. In early 2024, I began to study options trading, buying and studying over 24 books over 7 months. My first trade was on November 21st of 2024. From that date until February 7th of 2025, about 2.5 months, I completed 27 option trades. 6 of the 9 vendors did not do well enough for me to desire to continue to act on their alerts. Among the 3 surviving vendors, only the Joe Duffy option trades were all profitable, with 5 trades, each earning over $500. Both the other vendors that I decided to continue to use had losses. For the total profits, no losses, of Joe Duffy's 5 trades, the sum was $11,606. For the total combined profits and losses of all the other 22 completed trades, the sum was $21,944. In other words, the 5 Joe Duffy trades amounted to slightly over 1/3 of my total earnings, which was more than half of all other 22 completed trades. Thanks to FFR Trading and Joe Duffy, signed Herbert Solinsky. So Herbert, we see you there. I'm so sorry that we just couldn't get your mic working today. I thought I heard you there for a minute. But anyway, I think you all get the point. This is something, guys, if you think about it, this can change your life. If you've got maybe you've got a retirement account just sitting there, you've seen the performance numbers from these strategies and what they can do for your portfolio. You know, what would it be if you could add, you know, one of Joe's or both of these strategies to your portfolio? Could completely change your financial life, could change your ability to have a retirement. And we've worked with many clients here at FFR that didn't know what they were going to do for retirement, and now we'll have a retirement because of some of these programs. So what do we have for you today? Well, those of you on the webinar today, all right, the first 10 members only. We got to keep these spots limited. We can't have, you know, thousands of people taking the same trade, right? It can come up on the big banks' radar and they'll trade against it. We don't want that. So, and also the size of Joe's office, the help that he's got available to work with you, right, is limited. So for the first 10 members only, if you subscribe today to Joe's program and you'll receive 1 year of trading free. Right, so subscribe to a year of target zone and quantum, and you'll receive an additional year free. Right, Joe is also throwing in a bonus. He's offering $1,000 sign up credit. Right, so you can use that $1,000 towards these programs and get an additional year of trading for free. For anyone that attended this live webinar, you got to call the main office to request your free educational package. I would just have to make sure that you did attend. All right. Here's the numbers to call. Here in the US, you can call the 800-883-0524 number. Right? We do need to speak to you because we have to make sure these are a good fit for you. We don't just put anybody into these programs. Okay, we have to make sure it fits with your goals, what you're trying to accomplish, all right, your risk tolerance and all those things. Now, outside the US, you can use the number here, the 737-292-4425. All right, so I'll leave those numbers up, but you do need to call us. All right, the first 10 that call will get those special bonuses. And again, those that had questions on the performance figures, just call us. All right, no obligation. A strategist will go through the numbers, going through all the numbers since inception for all the programs, and you get those questions answered. Right, then you can make an informed decision if this is a good fit for you. So again, Herb, I apologize. I wish we had gotten you on. Maybe we can try again another time as you've got even more trades under your belt there, maybe even more impressive. And Joe, thank you again for joining us here. Any last words of wisdom from you, Joe Duffy, to those listening here today?
I will say this: if you're doing your own trading, which I'm trying to help you do, I'm not here to, sharpen my own axe. It is becoming a market of stocks rather than a stock market, and by that I mean that most of us who've been in trading any length of time have been weaned on a rising market, rising tide, floats all boats, and a sinking, market sinks all ships sort of thing. But more and more and more and more, we're seeing stocks marching to their own drummers. And I think you have to be less concerned, unless you're trading the S&P or trading the Qs, ETFs, what the general market is doing, and more concerned about what your stock is doing. And I know there's been some inertia for me to overcome, thinking, wow, I don't really want to trade long or trade short in this market, and then having a stock that looks like it really needs to be bought or really needs to be sold. And there was some inertia there for me, and sometimes there still is, to be honest with you, but it's becoming more and more a market of stocks, and stocks are marching to their own drummer. So that's something that I think you need to be aware of, that what seems like a bull market has plenty of opportunity for shorts, and even vice versa. You know, look at a stock like Visa. It just keeps marching on to new highs, doesn't care what the rest of the stock market's doing. Recently, the end of last year, Apple dropped 15, 16, 17%. Markets marching to new highs. If you even go back 2-3 years ago, if Apple dropped 15%, the market wasn't marching to new highs. So we're seeing divergence from the averages with a lot of stocks, and I think you need to be less concerned with watching what the S&P is doing and more concerned with just what your stock's doing. So change in environment, I guess, is my advice, final word of advice. Yeah.
And Joe, evidently, I missed one piece. It wasn't in the slide here. I'm being told that you are voluntarily giving away to the first 10 subscribers your X-ray indicator. Maybe you can talk about the X-ray indicator, what that is, and what they'd be getting if they are one of the first 10 callers here.
Yeah, unfortunately, I shut my trading view off because it's I didn't want to compete with the bandwidth of the for the meeting we're in right now. But X-ray, as I think I alluded to before, it's one of the systems I use, and it's a very simple system to use. It will show you red bars and blue bars. And the market is never as easy as if A then B. So it's not just sell every red bar, buy every blue bar. There are conditions that have to be present for you to do that. But generally, you'll want to be looking to buy long when the market has blue bars, and the program, what X-ray does is paint the bars for you blue or red. Then there's a band along the bottom, and if it confirms For instance, if the bar switches from blue to red, and then you look down below and the band is also red, then you have permission to open a short signal. And similarly, if the price bar switches from red to blue and you look down below and the band below is also blue, you have permission to enter on a long signal. So that program will work with TradingView. It'll even work with the free version of TradingView, actually. Um, and it works on a longer term charts like end of day. One of my favorite time frames in TradingView is to combine 2 days into one bar, and I like to look at that. But basically it's a swing trading tool, basically for daily kind of swing trading charts. But it's a rule-based system, and will help you stay on the right side of the market. It limits your losses and can get you into some pretty big trends.
All right, fantastic. Well, I'm glad we mentioned that before we disconnect here. So add that bonus, guys, to this, the X-ray indicator. All right, one of the first 10 callers, you'll receive this X-ray indicator. All right, gratis. And again, that works with TradingView. That can also be a great adjunct to your your analysis. And go ahead, Joe.
Just add, John, sorry, just to add, it's not hard to use, but it comes with 6 or 7 explanatory videos. So it's even if you're new, you won't be confused.
All right, perfect. And again, the numbers to call us, again, we do need to speak to you. We don't just put people in programs that are not a good fit for them. So give us a call. You'll speak to a strategist. They'll give you all the information you need to make an informed decision, including all the performance data, right? All the nitty-gritty that you need to know before you get involved. But again, it's the 800-883-0524. If you're outside the US, you want to use the 737-292-4425. If for some reason you don't have a phone, you can email us, support@ffrtrading.com, and we'll make sure a strategist gets in contact with you and sets up a time to go through all these, all the numbers and all the specifics for the programs. All right, so thank you again, everybody, for joining us. We did run a little long, and I apologize for that. Hopefully, we can bring Herb back another time so you can hear from him. He does have a great story. We'd love to have you hear directly from him. But Herb, thank you for making the effort anyway. And for everybody else, on behalf of FFR Trading, Joe Duffy and Herb here, thanks for joining us, and we'll see you again in the next webinar. Take care. Have a great rest of your trading week.
Thanks, everyone.